Chat with the LMC Mortgage. I'm Jill Bloom. Did I say that right? Shelly Weatherall, one of our loan officers. Angie Pryor, loan officer. Carolyn Phillips, VP and loan officer.
The Wizard.
The Wizard, exactly. Today we're going to be talking a little bit about credit scores and how your credit score is affected by inquiries on your credit report. So we were just discussing amongst ourselves. My son, congratulations, William, bought a truck for the very first time. We were talking about how credit inquiries can affect your credit score for things like purchasing a car, purchasing a home, all things.
Credit cards.
Amazing are affected by credit score. Yep. Homeowner's insurance even is affected by your credit score. So I was just telling them that the dealership told us that William's credit score could be affected if he didn't purchase a truck right after he had his credit pulled by a bunch of people. And then that got us talking about how mortgage pulls, when you apply for a mortgage, can also affect your credit score when you're shopping around.
I think we were most surprised when digging into this how much information is out there and how much of it doesn't match up. It's a very inconsistent thing, and even when we were chatting,
we were like,
Shelly thought one thing and I thought another, and so this conversation is just to get you to explore and get you to do your homework and ask the questions, and we'll certainly provide you with what we believe to be.
What I've been told by true credit experts is it depends. It really does depend on your credit profile, how much credit you have, how long you've had credit, as to how it will affect your score.
Oh, that was another thing we found out when shopping, is that your credit score in general is considered a thick credit score or a thin credit score. Like someone that's young, purchasing their first home, purchasing their first car, they have thin credit. So even if they have a great credit score, like a 780, if they have thin credit, it affects what their interest rate is on different
credit
things.
Meaning you don't have a lot of different
because you're young, you only have one credit card or something like that. And mortgages is the same way. You want to have a strong credit profile of a credit card. An automobile loan is another really great thing to have because it's considered installment credit. And then of course if you had a mortgage, before,
that kind of prefer, like
even
round
better.
it back out,
Exactly.
And when you're getting a mortgage, the biggest thing that we're looking for is stability. 2 years. We're looking for 2 years on your employment. We're looking for 2 years on your credit. Not that you
it's like
have
a
to have
celebrity
those things.
relationship, at least 2 years.
Right. But but if you have those things, your likelihood of getting the best program out there and your options open up if you have that stability. We can show that stability for you or help you do that.
I think all of us, when we take an application and we ask, how long have you been on your job? And they say, 2 years. We're like, oh, woo!
Yeah, exactly.
Because our questions for that topic end right there.
Yeah,
Right, sure.
But again, it shows that stability. It shows you started something and you're following through with it. You haven't been at 7 places in the last 6 months.
Absolutely. And another thing that we were discussing right before we started this too is that we're sorry that this is more than a mortgage minute. Sorry, girls. So it's chick
We're
chat.
just passionate about mortgage topics.
But when you're shopping for a mortgage and you let multiple different brokers pull your credit, we were discussing, is it true that can damage your credit score? Because there's information out there that if you shop within a 14-day period, that it only pulls your credit one time. It's called a soft pull.
Or a 30-day period is what I've been taught.
Or even a
Or
30-day.
45-day period.
Right.
Yeah.
But if you have a whole bunch of people pull your credit and you go past that 14 to 30-day window and then you have more mortgage people pull your credit, it can make your score go down for those latter people. So when you're out shopping, don't just let every single person you talk to pull your credit. Keep your Social Security number to yourself until you kind of feel comfortable with what rate, fees, programs you want to go on. Then let someone do it.
Because
there are certainly a lot of lenders that will refuse to even talk to you.
Nice.
There's a lot of lenders that will refuse to talk to you unless they pull your credit, and that's not true. You can give them an estimate. Keep in mind it is an estimate. So if your FICO score, we'll let Shelly touch on that. If your FICO score is a 720 and your mortgage pool is a 680, your mortgage pool is a completely different pool. So if they're running an estimate on you based on a 720, when we actually pull your credit, it's going to be different.
Right.
You want to touch on what a FICO score is.
Right, because I have so many people, that's probably the #1 question. Well, on my Discover card, it says my credit score is 740.
Credit Karma.
Credit Karma. A lot of these that are going to get, almost every credit card now kind of gives you your FICO score, which your FICO score is a pure score. It doesn't have any of the other weighted categories. Credit is a huge beast when you really think about it, and there are all kinds of algorithms for what mortgages, what do we want to put more weight on, for what automobiles want to put more weight on, what credit card companies put more weight on. And so usually it's about a 15 to 20 point difference. So if someone tells me they have a 740 on whatever my FICO is showing on their credit card statement, I usually come pretty close with the 720. But again, if you tell me you're somewhere at 720 and 740, I can give you a ballpark of rates and fees without pulling your credit. And a lot of times I prefer to do that to make sure that we aren't just pulling credit.
Have you guys wondered why do we care so much about a 700 credit score versus 720 credit score versus a 740 credit score? You can get your best interest rates the higher your score is. And the reason that it's even that way is that there's performance statistics out there that say people that have these higher scores are going to perform better. So
Less risk means a better rate.
Yep.
Yeah, absolutely. So the good news is, you guys, is that we have a fantastic blog done by Kristen, our social media director, and she has posted this to our website, which is myblnc.com. So please go to our blog and on our website and read a little bit more. I know it's so much fun listening to us talk about it, but if you'd like to get a little bit more information, please feel free to visit our blog or call one of us at 864-255-3173. And we'll see you next week on Chip Chat. Bye.